Okay, guys, are you now sure you understand that financial reports are needed, both for legal reasons and also to make sure that you keep firm control on how your business is performing, not only now, but how it is likely to perform in the future? Hey, Jim, you look a bit worried.
Well, yes, I am. I mean, all this cash flow stuff, projected profit statements, profit and loss accounts and balance sheets. I just want to get on with the job. Do I really have to understand all this?
Not at first, Jim, but as we go through the first year, and as we have more meetings, and as you discuss the way things are going with John, things will become much clearer to you. So let's start with cash flow. Now, cash flow, the important thing is to realize that it is different from the cash book, where all you do in the cash book is keep a record of checks received and cash that has been banked, with checks paid and cash withdrawn from the bank, which is reconciled with the bank statement. The difference is that with a cash flow statement, we divide the cash into three very important sections, being from operating activities, investing activities, and financing activities. Although you will be much more familiar with cash flow from the operating activities, which deal with customers, suppliers, and employees, from the point of view of the business as a whole, it is vital to keep control of the cash from investment activities and financing activities. And no matter how well the business is doing, as I said, no matter how well the business is doing in its day-to-day operations, these other two categories are of vital importance, enabling you both to understand and keep control of your business. What do you think of all that, John?
Honestly, I still find it confusing. But as our admin girl will be doing all the paperwork, I expect it will be gradually become clear to me.
You're absolutely right there, John. Just remember that there is a huge difference between the cash book and the cash flow statement, and that both you and Jim must make sure that you always give thought and planning to the investment and financing side of things. Now let's talk about or think about profit and loss statements or profit and loss accounts. These statements are usually prepared at the end of the financial year and cover a whole year of work. They show all the income that has been received in the year and also all the income that has been received in the year, and include all income that has been earned in the year but has not yet been received, and show all expenses for the year, including expenses that have been incurred in the year but not yet paid. The result is a profit or loss for the year, and it is this statement, after the profit is adjusted for taxation purposes by your accountant, that forms the profit that the business will be assessed on for tax purposes. What do you think about that, Jim?
I understand all that except for this taxation business, but I will get our accountant to explain that at the end of the year, so no problem.
Okay, now let's look at the balance sheet. It is vital to remember that the balance sheet is an account of a business as it stands at a single moment in time, usually at midnight on the last day of the financial year. It shows all the assets that the business owns at that moment in time, all the liabilities at that moment in time, and shows how much the business owes to the owners at that moment in time. It is very important to remember that the balance sheet shows the position of the business at one single moment in time, whereas the profit and loss account shows the profit and loss of the business for the previous 365 days.
But what happens to the profit in the profit and loss account? Is that shown in the balance sheet too?
Yes, I also want to know about this.
A good question. I think you're both correct that many people find this very confusing. Now, the profit for the year is shown in the balance sheet as it belongs to the owners of the business. It is shown as an addition to the owner's capital. It is important to realize that from the viewpoint of the business as a whole, the business as a whole owes money to the business owners. As the business as a whole owes money to the business owners, this debt is shown as a liability. Put simply, the difference between the assets and liabilities as shown in the balance sheet equals what the business owes to the owners. Okay, guys, that was quite a lot of stuff to absorb. We can have a chat in more detail over lunch, but let's now go and have a nice meal at the local cafe, which I understand is just across the road. Thanks very much.
Thank you. All right.